Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer of Financial Enhancement Group. So thankful you took the time to open up the video, and give us a few minutes of your time where we're going to talk about the things we found important or worth sharing from this week's investment allocation meeting. Specifically, we're going to go over the infrastructure bill. We're going to talk about cyclical stocks. And then lastly, the ever so important inflation data that's been top of everybody's mind these past couple of readings. But first and foremost, the infrastructure bill. So again, we're talking about this piece that was passed by the Senate, the bipartisan piece that both parties had agreed to, at least in majority. And we're talking about $550 billion of new spending, plus the nailing down the coffin on some additional spending. So we really try not to get ahead of legislation that hasn't been put into full practice. But we have to balance that with the probabilities. And the probability is that some infrastructure, at least in part, was going to be agreed upon by both parties. So we have certainly some exposure to these groups in the portfolio, some in the way of earth moving stuff, where roads, bridges, and stuff is always infrastructure, but also in power infrastructure, which really come into play when we saw what happened to Texas and the meltdown of that power infrastructure that's desperately in need of some upgrades and brought up to the 2020 standards and improving. So there's certainly a lot of ways to play this going forward. And then I'd also be remiss if I didn't mention clean water as well. So a lot of things in this infrastructure bill, maybe it gets added to, maybe it gets adjusted in the House going forward, but in some way, some balance of infrastructure bill has been at least moved forward after kind of a several week stalling by the Senate. So this legislation is very likely behind a shot in the arm to cyclical stocks. Here specifically, we're looking at the S&P 500 value. The orange is the S&P 500. The purple is the S&P 500 value, which is full of cyclical stocks. When we say cyclical, what we mean is that they are tied to the economic cycle. The stronger the economic cycle, the better this group of stocks tends to do. We're looking at industrial stocks, financial, material. These things are closely tied to the economy, and at least in today's investment environment, very much value stocks. They had been outpacing the S&P 500, something that we've had no shortage of sharing with you in previous market carvers, had been outpacing, but it had been decelerating recently. So infrastructure spending, very likely one thing. Of course, that's a boost to overall economic activity and a positive for cyclicals as we see them retake some ground against the S&P 500. Here's another look at it from a technical angle. This is from Andrew Thrasher, our chartered market technician. The top panel is the S&P 500. If you look at the bottom, we'll start there. Defensive stocks, consumer staples, healthcare, telecommunication, utilities. These stocks, is very typical for them to do well in the summertime when the overall market has a tendency to be flat. So there's a seasonality element to this, but they have been trending higher as we move throughout the summer. But cyclical stocks have had a lid on. After running really hard and really well into the late spring, they have been under lid, unable to grab new highs. That changed last week with this so-called shot in the arm. They have begun to do a little bit better. That's very critical from a technical perspective that they hold this breakout level. So stocks like Fresh Air, it's very good for them, but it would also be very bad to fall back under that. So as we see some choppiness this week, nothing goes up in a straight line. We really want to see that hold for that group of stocks. And last, we're going to talk about inflation. Last couple of readings, super important for inflation specifically. Well, not just because it's on all of our minds and there can be a lot of fear-driven headlines about how high the numbers could be, but very important for the Federal Reserve, which has as one of its two primary mandates, sound and reasonable price increases, or moderate inflation is another way to say that. So the hotter that these readings were and the more that they stayed that way, the more pressure that was going to be put on the Fed, which has not only low interest rates, but the expectation that they stay low for a long time and keep aggressively purchasing bonds. So all of those are pedal to the metal policies for the Fed. So the longer inflation stayed hot, the more pressure that was going to be put on them. So what we saw from this last reading is that inflation data not only cooled, but they cooled a little bit more than expected. Part of this is because we have comparisons that are to a different part of a year ago. So May, June, July, those were really steep last year, last harshest part of coming out of lockdowns and every part of the bad economy. So we were comparing against really low numbers in the past few months. So as things began to recover as we came out of last summer, the comparisons mean that the rate of growth isn't going to be quite high. So some quirks there in terms of inflation, but also some just general moderation. You have a lot of commodities catching their breath. Lumber is not a big piece of this, but I think it's a good poster child when it ran seemingly out of control for a long period of time. And inflation now lumber has just basically given a bunch of that up. So some cooling off and natural things to the economy that happened, certainly with the commodities piece of it. So the important thing for us for inflation is really where asset prices are tied to this in relation to what the probability of what it will be. So for instance, in the spring, investors really began to pay up for things that were tied to inflation because of this data that was going to be coming in, most likely to be really hot. Those would be inflation protected bonds, a lot of stocks that do well in inflationary environments. The prices of those had moved up so well, in our opinion, the probability that inflation was going to continue and run out of control was really low, and that we would have a moderation. So we gave up on a lot of those stocks. And so now we see that beginning to trend down. We might get a chance to change our minds and go back the other way. And I say that because going forward now, that we begin to see some cooling off, and I think we'll continue to see that. But going forward, shelter, the way that we measure and capture the inflation of housing prices, which is the biggest component of this consumer price index by far. All right, it should make some common sense into how much of the average household's housing costs. There's a really quirky way that we measure and capture the cost of home ownership and rentals. And so there's likely to be a very long lag when housing prices have ran up big time. And that will put pressure on rents, most likely, going forward in the next 12, 18 months, and should put a nice little baseline. So while this data cools, I think that'll put a nice tailwind and a nice support. So if things get too out of whack, it might be time to go the other way and grab assets again. That'll be inflationary. But that's how we calibrate it. We as a team have different outlook on where inflation will go. If you were with us in the spring and caught the third lead, Joe and I had a little back and forth, and you caught maybe some of our different views. That's okay. That's all healthy debate. The important part is that we calibrate where the market is versus where the probabilities are of inflation going forward. So I really thank you again for the few minutes that you gave us for this week's Market Carver. If you want more, don't forget you have our radio show, Consider This, that you can catch live in a few instances on the radio or through a convenient form of podcast. Thanks again, and have a great weekend.